Welcome to another episode. My name's Jose Najarro, and today we're going to take a look at some of the cruise line companies. So let's get started. Before we begin, I also did a video similar to this, but based on the airline. So after you finish watching this video, if you guys enjoy it, definitely go check that video out. Also, don't forget to subscribe. I definitely post content almost on a daily basis, so I hope you guys are enjoying it. And make sure to post in the comments to let me know what you guys think. Just for all the information that I collect here either comes from lazyfa.com, 10K reports for each of the companies, or fidelity.com. These are the three main sources of my information. So we're going to take a look at three different cruise lines today. We're just going to take a look at an overall based information of the company. So the main thing I'm trying to take a look at is see which of these companies is going to be able to survive the most. So what I mean like that is I do believe all three of these companies will end up, I don't think any of them will end up bankrupt. Obviously, I can't tell the future, so that might not be true. But I don't see any of them actually going into bankruptcy. But I want to see which one of these three has the strongest balance sheet to then determine which one of these three is the strongest out of them. So we're going to take a look at RCL, Royal Cruise Lines, CCL, Carnival Cruise Line, and NCLH, Norwegian Cruise Line, I believe, is the full thing. And here I have their percentage drops since their all-time highs. And this is pretty ridiculous. If you guys followed my airline video, some of the airlines, some of them dropped about 50%, others dropped about 30%. And there you can actually see which companies had the stronger balance sheet just by the percentage drop, right? The market was kind of telling you, hey, this company dropped this little because we believe it's stronger. It has a stronger balance sheet compared to the other ones. Here they're all pretty much dropping around the same level, plus or minus 5 points, right? We have RCL down 64% from its all-time highs, and this is ending on Monday, March 9th. So 64% down. We have CCL down 62%, and we have NCLH down 67%. That's the biggest of all. But we can see right there, it's not that much difference. It's plus or minus 3 from the 64 is what it seems to be. Next, we want to take a quick look here at my chart up on top of me. We're taking a look at the market cap and the trailing 12 months revenue. And I just wanted to see what the current price to sales ratio for this company is. And they're all pretty low. We can see RCL has right now has a market cap of $10.1 billion. And in the past 12 months, it made $10.9 billion of revenue. So that gives this company a 0.92 PS ratio. Then we have CCL, which has the biggest market cap at $14.7 billion, and it collected 20.8 in the past 12 months, which gives it a price to sales ratio of 0.706. And then we have Norwegian Cruise Line, which has a market cap of 4.2 billion, which is the smallest of them. And usually this is one thing you see. Usually the smallest of all the companies usually takes the biggest hit. And we can see that happening here. Norwegian is down about 67%. And in the past trailing 12 months, it collected $6.4 billion of revenue, giving this price to sales ratio 0.65. So right here, if we take a look at just the price to sales ratio, this to us tells us that Norwegian is cheaper than Royal Cruise Line. The most expensive is RCL. The cheapest is NCLH. Now we have to see, why does the market believe that this is true, and would I agree with this valuation? I do think the biggest issue these cruise lines are gonna affect in the short term is to pay down debt. And they're going to have to be able to liquidize money or have some form of liquidable cash assets to be able to pay their debt. Just because the slowdown of revenue happening, I'm pretty sure less people are booking cruise lines compared to the normal, right? I'm not sure. We don't know yet how bad it is, but I'm pretty safe to assume that it is less than the normal value. So we're going to see a bit of revenue go down. So cruise lines still have bills to pay, right? And if revenue goes down, they need to find ways to be able to pay off this cash. So how would they be able to pay off this cash? The first thing is we have to see what they have in the bank. This is usually in the balance sheet. We'll be able to see what kind of assets they have, what kind of quick assets will they be able to get into. If they don't have any form of quick assets or not enough, there's other things that they can do. The first thing they can do is dilute shares. Dilute shares, if you guys saw my airline video, I did not think that any of those airlines would dilute a heavy amount of shares. But after taking a look at these balance sheets for the cruise lines, I think dilute shares or senior notes or loans is definitely going to be one of the, they are going to do one of these. So dilute shares, right, you increase the amount of shares out in the public, which reduces the overall value of each share in some form of aspect because they collect less earnings per share. Senior notes are just a long-term debt. If they don't get paid off, then they pay them off in some form of share. So it's another form of dilution. And then just your typical loans with interest rates. So these are the three ways that this company will be able, any of these companies will be able to collect money or get money to pay off their cash. So now let's take a look. First, let's take a look at RCL. Is going to be the first one. So RCL, let's take a look at how we have them. So as of December, this company has $1.5 billion of liquidity. 243 comes from cash and cash equivalents. 1.3 billion comes from unsecured credit facilities. So that's just money that it's pretty much a credit card. They have $1.3 billion in credit card credit, and then they have $253 million in cash or cash equivalents. Their current debt, unfortunately, is $2.72 billion. So they're still short about $1.2 billion. They're still short, even if we count their cash and cash equivalents and their revolving credit. So what we're gonna most likely end up seeing is they're either gonna have to find some more form of credit line, or again start to dilute shares. So let's take a look at how. One thing I do like, so like I said, right, you're gonna see later on, if you guys watch the airlines episode, I feel like certain airlines had strong balance sheets, like really strong balance sheets, but I don't think any of the cruise lines have a very strong balance sheet. We're gonna see profit margins for this year for Royal Cruise Lines was 17.2%, not bad. They do have better profit margins than airlines, and we can see here the maturity rates of some of their senior notes. They have 2.6 billion, which is part of that current debt, due this year. Next year they have 843 million. On 2022 they have 2.5 billion. So like I said, for short term, I think this pretty much is just going to affect 2020. So that's why I'm really only focused on current debt and not long-term debt, anything after 2020. Now let's take a look at their itinerary here at Royal Cruise Lines. They made a total revenue of about $10.4 billion in 2019, and 6.4, so over 50, about 60% of the total revenues comes from North America itineraries. And when we say North America, we include United States, Canada, Mexico, and Caribbean. So that's a huge portion. And who are right? All cruise lines are probably being affected. But my gut feeling would tell me, just with the way things are going, that Asia Pacific and Europe cruise lines are probably taking the bigger hits opposed to North American cruise lines, right? With the big fear in China, the big fear in South Korea, and the big fear in Italy. So I would feel like those are the ones taking the biggest hit, just from gut feelings, right? Right now, we haven't seen any true numbers come out. But this is pretty much just me thinking of how things are going. All right, so with Royal Cruise Line, right, I'm not a huge fan of their balance sheet. They have only 1.5 billion of liquid cash, but they have 2.7 billion dollars of current debt. But they do have a decent profit margin. So now let's take a look at the next one. Next, we're going to take a look at CCL, which is Carnival Cruise Line. Carnival is the princesses cruise lines that we keep seeing on the news, and I do think this one's getting hit a lot by the news. So this company has about $3 billion in revolving credit, and right now out of that $3 billion, it drew 200 million. So it currently has 2.8 billion dollars of credit, revolving credit. So that's pretty good. Let's take a look at this company's current debt. This company has a current debt of $1.8 billion and cash equivalents of about 500 million. So if we add that 500 million to that 2.8 billion of credit facility available to it, this company has about $3.3 billion of liquid cash. So this company can actually pay off its current debt. And I forget what article I was reading, that some analysts were saying that Carnival Cruise Line, CCL, had a better portion compared to the other ones, and I can see why. This company, I still don't like that most of the cash is coming from revolving credit, right? Because at the end of the day, that's still going to be a loan of some form. But this company at least can come up with some quick cash to be able to pay off its current debt. And we can see here maturity rates. In 2020, they have about that 1.8 billion, which is the current debt. And then pretty much the rest is anything else. Next, let's take a look here at how their itinerary is broken down. In Caribbeans, they make 30%. Europe without Mediterranean makes up 14%. Mediterranean makes up 13%. So Caribbean makes 30%. Alaska makes 6%. Australia and New Zealand, let's say those are not affected. About 40 to 45% comes for me from areas that I don't think are truly impacted, composed to like China and Europe, right? So it's I do think itinerary wise, North America, RCL has better chance that more people are gonna go to RCL than CCL. Also due to the news, right, that most of the cruise lines that's shown on lockdown are from CCL. Profit margins are also pretty good, 14.4 for this past year. We can see, right, profit margins for RCL are a bit higher compared to CCL, but CCL does definitely have a better balance sheet than RCL. So you got to take whichever one you want. For me, in my opinion, I prefer a stronger balance sheet over profit margins at a time like this. Finally, the next one we're going to take a look at is NCLH, and I'm pretty sure this is Norwegian. Norwegian is the smallest out of all of them, right? It was $4.4 billion of market cap, right? Compared to the next biggest one was RCL at 10.9. So it's 60% smaller than the second one, and it's about 70% smaller from the biggest cruise line ever. So sometimes being the small one is not that bad, especially in times like this. In my opinion, being the smaller one means you have less ships. If you have less ships, then it means you have less expenses to worry about if you don't have any true revenue coming in. And it also means you have a better chance to control things. I feel like if you have less cruise ships, you're able to train everybody a lot. You're able to have better training. You're able to maintain a stronger cleanliness around the cruise line ship. So now let's take a look at liquidity. This company has $1.1 billion in liquidity. 252 million come from cash and cash equivalents. 875 million come from revolving credit line. And again, this is one of the things I'm not a fan about the cruise lines, right? Unlike airlines I think had a very strong balance sheet compared to cruise lines because they did not depend solely on their revolving credit. A lot of them had plenty of cash or current investments available. Where these cruise ships, I feel, have decent cash, very minimal cash, and truly rely on revolving loan credits. So that's 1.1 billion of liquidity, and this company has current debt of 746 million. So again, this company is pretty much like CCL, that it has a decent balance sheet to be able to withstand at least 1 year. Profit margins for this company is 14.4, very similar to CCL, but I do believe that I think NCLH is a little bit better off just because it's a smaller company. Next, let's take a look at the itineraries for this company. Total revenue was $6.4 billion, 3.8 billion. So over 50% of the revenue comes from North America. Europe makes up a huge portion, and Asia Pacific make up a huge portion as well. So Europe and Asia Pacific make about 40% of total revenue. So So we can see that even though this is a smaller company, it does seem like the affected areas might be holding a bigger portion of the itinerary. So now, my thoughts. These are my thoughts real quick. Unlike airlines, right? I just did the airline video, and I do believe that airlines have a really, really strong balance sheet when compared to the cruise lines, especially like I think JetBlue, Delta, and Southwest all have very nice balance sheets. So now independently, RCL, Royal Cruise Lines, most of their itineraries are in North America, which I think are good. It had the highest profit margins of them all, but at the same time, it had the worst liquidity of them all. $1.5 billion of liquid compared to $2.2 billion of current debt. Next, we have CCL. This one has way better liquidity. It has 2.8 billion plus 0.5 billion of cash, so about 3.3 billion in liquidable assets, and only 1.83 billion dollars of current debt. Again, a huge portion of that asset comes from a credit line facility, which at the end of the day just becomes another loan. This one has good profits. I'm gonna stop repeating that. I do think all of them actually have decent profit margins. RCL though has the biggest. CCL's itinerary is a little bit more diversified, and unfortunately, CCL are the cruise lines that we keep seeing in the news report at the moment being quarantined. All the princesses come from CCL. Next, we have NCLH. Liquidity is also good for this one, and it is one of the smallest one. It is the smallest of them, so that's why I do enjoy it the most. I do think the least you have, the less expenses you have. $1.1 billion of liquidity and $0.75 billion of current debt. So this company definitely has enough liquidity to pay off that current debt. North America makes roughly about 55% of the itineraries, which is not bad. Like I mentioned, right, they all have decent profit margins. This one does. But NCLH, I think it has the cheapest price to sales ratio, right? I think it was 0.65. So you're paying 65 cents for each dollar this company makes on sales, which I don't think is bad, right? The profit margins, right? The profit margins is not as high as RCL, but it does have great liquidity, and I don't see any of them standing out too much. The only thing in a good way, I don't see much of them standing out. But in a bad way, I do see RCL with that horrible liquidity. For me, my favorite is NCLH, but unfortunately, right, this market just keeps beating down these cruise lines left and right. Every day is a 10-12%. So I honestly not sure if I would pull the trigger anytime soon on these companies. But it is good to note that for the future, if once I feel like I feel comfortable investing in this, I do think NCLH would be my favorite. So I hope you guys enjoyed this episode. Take care, have a good night, and see you next time.